Hello and welcome to Virtual Investor Conferences. My name is Phil Carlson, and on behalf of KCSA Strategic Communications, as well as our co-host OTC Markets Group, we're very pleased you have joined us for our next live presentation from NewLake Capital Partners. Before I introduce our speaker, a few points to note. Please submit your questions in the questions box to the left of the slides. If you're interested in scheduling a meeting with NewLake Capital Partners, please click on the Meetings tab found on the left navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Anthony Caniglio, President, CEO, and Director of NewLake Capital Partners, which trades on the OTCQX Best Market under the symbol NLCP. Welcome back, Anthony.
Thank you, Phil. Thank you so much for having us again, and thank you everybody for joining us this morning. My name is Anthony Caniglio, and I am the CEO of NewLake Capital Partners. I'll walk you through our presentation and then open it up for questions. I'd like to ask you to please note our safe harbor statement. Let me advance to it. I'd like to note our safe harbor statement, and the presentation may include forward-looking statements. Actual results may differ materially from those expressed herein. And please refer to our website, newlake.com, for additional disclosure information. So for those of you not familiar with NewLake, let's talk a little bit about our company. We're a triple net lease REIT, and we're a leader in providing real estate capital to the cannabis sector. Our model is simple. We acquire mission-critical properties from and for experienced cannabis operators. We collect rent, and our investors enjoy a healthy and growing quarterly dividend. We founded the company in 2019, and we have a stellar team that's created significant value for investors and possesses significant experience in real estate, cannabis, and financial services that I'll expand on in a moment. With 31 properties across 12 states, we're one of the largest owners of cannabis real estate in the country. We have the scale to compete, the scale to meet the needs of our tenants and the industry more broadly. Our portfolio is a point of pride for our team. We're 100% leased, and we've collected 100% of rent since the founding of the company. Our team has done a great job assembling a diversified portfolio with meaningful duration and yield. And for those of you not familiar with the commercial real estate industry, a 12.2% yield is almost unheard of. We're also proud of our financial strength. We have relatively no debt. It's $3 million in total, $2 million from a seller note, that's at 4%, and $1 million we drew on our credit line. And we do have a $90 million credit line that we announced earlier this summer. And this allows NewLake to have financial flexibility as we continue to grow the company. Our focus on high growth industries such as cannabis with meaningful demand for real estate, as well as our built-in annual rent escalators, I'll talk about that in a moment. Those elements position NewLake to continue growing our available funds from operation, or AFFO, as well as the dividends that we pay out to our investors. Let's talk a little bit about our team. Our management team has significant history in running successful businesses. I've been in business for over 30 years. Price Waterhouse and JP Morgan I worked at for the better part of my career. I ran a few of the investment banking businesses at JP Morgan. My previous startup was a residential mortgage company, which I ultimately sold to Blackstone, to a Blackstone portfolio company, before founding NewLake nearly 4 years ago. Lisa joined us in June when our previous CFO retired. Lisa has a strong track record in public REITs and is a terrific partner of ours as we continue to scale and grow NewLake into the future. Jared Annenberg has done a terrific job leading our acquisition efforts over the past nearly 4 years after having a stellar run at CBRE. Looking at our board, not to be outdone, our board is one of the most impressive groups in the industry. It's a terrific mix of real estate, cannabis, and governance experience. For example, Gordon Dugan ran WP Carey, one of the largest net lease REITs in the country. Subsequent to WP Carey, he took over Gramercy Property Trust when it was sub $500 million market cap and grew the company and sold it to Blackstone for over $7.5 billion in 2018. Another person I'd like to mention is Pete Cadens. After a number of successful business ventures, he was a co-founder of Green Thumb Industries, one of the leading cannabis companies in the industry, and served as GTI's CEO for nearly 5 years through the IPO. We've institutionalized his knowledge, as well as Joyce Johnson, who's on the board of Air Strategies, institutionalized their knowledge and built upon that over the last nearly 4 years as we've been looking to make investment decisions, grow our portfolio, and manage risk. And that's a good segue to discuss our portfolio. We have a national portfolio of properties focused on limited license jurisdictions. These are jurisdictions where the license and the property are typically connected to each other. Limited license jurisdictions typically limit the number of operators, leading to a better competitive dynamic for our tenants and a better credit risk profile for us. To make an example of a limited license jurisdiction, think of Pennsylvania, where you need to go to a state-controlled store to purchase liquor and beer. And so the state has taken a similar approach in regulating cannabis and limiting the number of licenses in the state. So as I said, not only a good operating environment for the operators, but these licenses have real intrinsic value, which improves the quality of our tenant base and the value of the properties that we own. Our portfolio consists of premier credits, and as we continue to grow, we'll further diversify our credit exposure. In fact, our last 5 transactions were all with new high-quality tenants. And while we take comfort in this diversification, our top 5 tenants by exposure are some of the leading credits in the industry. We have names in there such as Curaleaf and Cresco and Trulieve. These tenants, along with others listed here, have quality revenues and adjusted EBITDA, and they're some of the leading players in the cannabis industry. Our national scale allows us to meet the needs of our tenants and our future tenants as their businesses expand and become more geographically diverse. We have a meaningful dialogue with our existing tenants about add-on opportunities as they look to continue to scale their businesses nationally, but also expanding their businesses within the scope of their current footprint. Operators know that we have the scope and the scale to grow with them. And similarly, the scale allows us to attract institutional capital, which we've done repeatedly over the past 4 years, to raise capital to fuel our growth. So how does the magic happen? Let's talk a little bit about our underwriting approach. 3 main pillars to our underwriting approach: licensing, tenant quality, and real estate. From a licensing perspective, we want to focus on the licensing regime at the location for our tenant. And as I alluded to earlier, this industry is very much state-controlled and state-driven, and different states have different licensing regimes. We focus on those limited license jurisdictions, as I said, that we believe generate better value for our portfolio and our investors. And in the chart on the left, you'll see that in states such as Oregon or Washington or California, you could see the proliferation of licenses, which creates meaningful competition and results in a marketplace that has more volatility, less margin, and sees more difficulty for operators to make ends meet and to survive. And so we focus, as I said, on those limited license states where you can see in this chart have significantly less licenses on the street. They have significantly better margins, and they actually have better staying power in their markets. So we spend a lot of time understanding the licensing, not just at the state level, but also at the jurisdiction level. We focus on jurisdictions. So an example of why we focus on jurisdictions is while California generally is an unlimited license state, we do own a property in California, but that's in the limited license jurisdiction of San Diego. In San Diego, they have 36 dispensary licenses for 3.3 million people. And our property there with Columbia Care is near La Jolla and Pacific Beach, and it's right off of I-5. And so it's a terrific position in a limited license jurisdiction that is operating right in line with the way we underwrote that transaction nearly 3 years ago. So license is a critical part of our underwriting approach, and it's a critical element to understanding how to underwrite the cannabis industry. Tenant quality. Of course, anybody that enters into a 15 or 20-year lease with a tenant certainly has to underwrite credit quality. And we do everything you would expect in our tenant underwriting, but there are a couple of key factors I'd want to focus you on. One is the management team's ability to operate a high growth business in a highly regulated market. This is not an easy industry to operate in with the myriad regulations at the state and local level. And we want to make sure that as the regulatory regime for cannabis expands well into the future with federal legalization, that our management teams at our tenants have the ability to navigate those regulations, navigate those regulators, and run a business with an eye towards compliance. Another key element we look for is the management teams and the business's ability to raise capital. One thing we know for sure about the cannabis business is it has a voracious appetite for capital. And assessing that team and company's ability to raise additional capital to continue to fuel its CapEx needs or refinance debt that's on the balance sheet is an incredibly important element of our assessment. We bring our collective experience in raising billions and billions and billions of dollars of capital for companies in our previous ventures and previous careers. We bring that to the table in making those assessments. And then, of course, the real estate. We are a real estate REIT. We are a REIT, and our core focus is on real estate. But here it's about understanding the cash flows of the particular property. And for those of you familiar with real estate, commercial real estate, you would find that roughly a 3.5 to a 4 times EBITDA multiple, that's EBITDA plus rent, generally a good metric to look at for what is the free cash flow available to pay rent from a particular property. In a 3.5 to 4 times ratio is a pretty darn good property. And you can see from the chart on the right that our properties tend to run well north of that, both on the retail side as well as on the industrial side. And we'd like to make sure that we're underwriting transactions and properties that can weather the inevitable grind in margins and in pricing. And in fact, we've seen that broadly across the markets in 2022 in the cannabis sector. And we think our focus on EBITDA coverage for our properties has served us well. So financially, I mentioned that NewLake is relatively unlevered, just the $2 million on a 4% seller note and $1 million drawn on a $90 million credit facility. We drew $1 million to make sure the plumbing worked. Our credit facility is fixed rate. It's a 5-year facility. It's fixed at 565 for the first 3 years and will float thereafter. So relatively no debt on the balance sheet, which affords us plenty of runway to continue to invest and grow our portfolio. You can see that we've consistently grown our dividend over the past year. We're very proud of that track record, targeting an 80 to 90% payout ratio. And from an expense perspective, we actually think we have a fairly low expense ratio given the size of the company we have, and we have the ability to continue to scale our business with relatively little additional expense. So we'll expect to see that expense ratio continue to decrease over time as we scale the portfolio. I would note for the audience that we are internally managed, and that means that we're not paying external fees to an external manager on a quarterly basis. All of our expenses are internal. And so all of the knowledge and experience and capabilities of our team really inure to the benefit of our shareholder base. We're going to open it up for Q&A in a few minutes, but let me first focus on the high growth industry that cannabis is. Rarely have we seen an industry with the growth dynamics of cannabis. In just a few years, this industry has gone from primarily a West Coast market that's dominated by sales in California and Colorado to a national industry that's been gaining steam with recent adult use legalization, which has been significantly expanding the total addressable market. And in fact, this coming election day, there are 5 states that have cannabis legalization on the ballot to take a medical market into a recreational market. I'm sure we've all seen President Biden's recent statement around pardoning cannabis, pardoning prisoners that are in federal prisons for cannabis possession, and also calling on the federal government to reevaluate the scheduling of cannabis, consider rescheduling or descheduling cannabis. There's been a significant outpouring of support from surveys and various industry groups for the SAFE Banking Bill, which is a bill that has passed the House, I think, at least 5 times over the last handful of years and is now sitting in the Senate. So recently, the ABA, just in the last week, the American Bankers Association and the NAACP both came out in support of passing the SAFE Banking Act. And so we'll see what happens in the lame duck session, but there's a tremendous amount of momentum, not just at the federal level, but also at the state level to continue growing cannabis. And in fact, if all 5 states approve the ballot box initiatives this coming November 8th, we will see recreational cannabis available to roughly half of the Americans that are in the country. We do expect that additional states are going to continue this march, not just of adult use, but also the expansion of existing programs by adding conditions or form factors, and also by new states adopting medical marijuana initiatives. And there are a handful of those that are going on. And in fact, keep an eye on the southern states. There's some action happening in Kansas and Mississippi and even in Alabama, where there are hearings at the state level on legalizing marijuana for medical use. And so we think it's undeniable that this industry will continue to expand, continue to grow, and many of the analysts in the sector project, call it a mid-teens to low 20s growth rate for this industry over the next 5 to 10 years. Quick review for everybody. We do have an experienced team. I know I'm biased, but I think we have one of the best teams in the industry. And the reason I say that is it's a complement of experiences that allows us to make better decisions. So we're leveraging the talents and experiences from real estate, 30, 40-year individuals that have 30 to 40 years of experience in commercial real estate, with folks who are leaders in the cannabis industry through a Peter Cadens or a Joyce Johnson, to people who've had long careers in financial services like an Alan Carr or Peter Marte. And by bringing these diverse perspectives together, we really have the opportunity to make better investment decisions. And we think it's born through the fact that our portfolio has collected 100% of rent since inception over the last 4 years. We absolutely have the scale and the early mover advantage to be one of the long-term winners in this sector. We've got an arsenal of capital and an exceptional portfolio to continue to attract new capital as we get through our credit facility and look to raise capital into the future. We have a very strong financial position given the relatively unlevered balance sheet we have today, so really affording us a lot of financial flexibility. We've continually raised the dividend over the last 5 quarters with a fairly manageable and low, I would even consider low payout ratio at an 80 to 90% payout ratio. Our last quarterly payout ratio was just around 80%. And so we're well covered on the dividend. We know that this industry will have some ultimate issues in terms of who the tenants are and some potential disruptions for rent. We're absolutely not immune to that, notwithstanding the fact we've received 100% of rent collections. We know that at some point in the future, and we announced this on our last earnings call, that we could have one of our tenants having disruptions. But with that low payout ratio, we certainly feel highly comfortable that the dividend is protected. And then lastly, from a long-term perspective, we're very focused on this high growth industry. Very few industries are out there today that have the growth dynamics that cannabis presents to us. So with that, thank you again for your time. I'm going to turn to some of the Q&A. Bear with me while we tee up some of these questions. Has the recent news from the Biden administration slowed down any prospect deals as people wait to see if safe banking will get done? It hasn't. And the reason I say it hasn't is we have a fairly large pipeline that we've been looking at. I do agree with the sentiment. I think people will wait to see before they execute. But quite frankly, we're waiting to see what happens as well, because the cannabis industry with safe banking is a different industry than cannabis without safe banking. We're also looking to see what happens in the midterm elections and what the complexion of the Senate and Congress will be. And that'll inform us what we think will happen from a legislative perspective in the next Congress over the next 2 years. And so there are some scenarios where we want to be a little bit more aggressive, and there are some scenarios where we want to be a little bit more conservative. And so much like some of the operators, we're going to really sit on the sidelines here and watch the election results and see what the impact is. How do you differentiate yourself for the cannabis industry versus traditional commercial property developers? We don't take tenant risk. Traditionally, property developers will acquire a property, entitle the property, build the property, and then seek to tenant it. We don't take that risk. Our properties are either brought to us through our relationships with the operators. They own the property. If they've used their equity to purchase the property, they might be operating in the property, or we might acquire a parcel of land for somebody and execute on a build-to-suit transaction, provide them the capital to build, say, a 100,000 square foot cultivation facility. We've done that a couple of times now. But in all cases, we're signing a 15 to 20-year lease in conjunction with that transaction. So we really don't like to seek taking tenancy risk or entitlement risk on the properties that we purchase. What can shareholders expect for Q3 and Q422 dividends? I wish I could tell you. I don't want to get ahead of our board. What I could tell you is we understand the importance of dividends to our investors. We believe that we have a strong and visible set of cash flows coming in on our business. We have a very reasonable and frankly conservative payout ratio with a fair amount of coverage. And so we feel good about where the dividend is, and our board will be making that decision on a quarterly basis. Sorry, I can't give you a more specific answer because we're not providing guidance on that. Has any of the recent cannabis news aided in your efforts to uplist the company onto a major U.S. exchange? Potentially is the answer. We announced earlier this year that we were proposing a restructure to national exchanges in the U.S. in an effort to qualify with their with the Controlled Substances Act, which is the key issue keeping us off the exchanges, and that we believe that those structures would allow us to uplist to one of the exchanges. Continue to be in dialogue. I continue to tell investors that the longer it goes, the less people should rely that we'd actually get there. In fact, I'd rather people don't think that make an investment decision thinking that we're going to get uplisted. But certainly the actions that Biden has taken make it incrementally easier to accomplish that goal and bring that goal closer. Anything that happens on the federal stage that normalizes this industry and that brings us closer to either descheduling or rescheduling or a safe banking, perhaps SAFE gets done with a safe harbor for the exchanges. All of that is a net positive to the industry, brings the industry into the daylight and positions us for uplisting into the future. What do you see as catalysts for the industry and NewLake over the next year? I'll go back to the elections. I think the elections are a real catalyst. So there's a couple of levels to this. I think a catalyst for us specifically in the elections would be what happens at the ballot box. We do have an option for expansion in Missouri with one of our tenants there. And should adult use pass in Missouri, we'll seriously evaluate exercising that option and looking to support the expansion. So there's an immediate investment opportunity for us there. Should that ballot initiative not pass, we probably won't pursue that. I would say that for the industry as a whole, safe banking is a real catalyst. We think that if safe banking passes, it reduces the cost of capital for everybody, including us. In fact, we actually think that safe banking benefits us more than it benefits the operators. And the reason we believe that is because, number one, the Safe Banking Bill is currently drafted provides a 6-month window for regulations to be written at the federal level. And in an industry that's legal in some states and illegal in others, it's going to take the federal regulators quite some time to write those rules. And I'll take the over on 6 months. I think it'll take them a year plus. In fact, it's taken decades for Dodd-Frank rules to get written, and it's taken a couple of years for even hemp legalization rules to get written. So I'll take the over on that. I think that if banks if they do step into lending in the sector, they're likely to want to lend to a diversified portfolio of professionally managed commercial real estate, such as NewLake. And in fact, if you look that we were able to raise $90 million of bank capital this year, while many of the operators weren't able to raise that type of bank capital. So we think it lowers our cost of capital and positions us to gather more capital to continue to grow our business. What other funding sources are available besides equity? Would you add additional debt? We certainly don't want to get too aggressive with debt. I think that we have a little bit of debt capacity beyond the current facility that we have. And we're not seeking to upsize the facility. We've communicated that we think it could take us 6 to 12 months to put this capacity to work. And so we don't want to put too much capacity in place today. I do think that there'll be more capacity for us available after we get through this $90 million. We'll also generate some internal capital from the retention of our earnings. I mentioned that we have a 80 to 90% payout ratio. Well, every dollar that we don't pay out is capital that we can redeploy, and that's highly accretive for our shareholders. We're very focused on not issuing equity to dilute shareholders. We don't think we're in a position to do that, don't need to do that, and have no interest at this time in doing that. So I think we have time for us to continue to use debt as the primary source of capital while we scale up our business and we evaluate and push on opportunities to uplist and other efforts to improve the stock price and get us to a valuation where equity becomes attractive. How many deals are currently in the pipeline? How many properties do you think will be under contract by the end of 22 and 2023? We don't provide specific guidance for what's in our pipeline and exactly how many deals that we would do, but here's what I would tell you. I would tell you that we're just as busy as ever. There are few operators, there are few organizations out there that have the capital availability that we do. And so anybody that is looking for capital that has a good credit profile is talking to us. And operators are looking at this current landscape as an opportunity to potentially step in where there's some weakness in the competitive environment and take advantage of it. And so it's a robust pipeline. We could probably deploy, we would be able to deploy all 90 million of our credit facility in 3 months if we wanted to, but we want to move a little bit slower. We want to move a little bit purposeful. And we always say it's not just about growth, it's about quality growth. We want to make sure that we have the right transactions. And again, go back to our underwriting. It's the right tenant with the right property in the right jurisdiction. And so once you look at all of that, we're gonna wait. We're gonna wait for the right pricing and the right property and the right tenant. So we're gonna be very, very disciplined in deploying the remainder of this capital. That is the last of our questions. I'd like to thank everybody for joining us today. We really appreciate you taking the time to learn about NewLake. Our ticker symbol is NLCP. Also, please follow us on Twitter or LinkedIn. We try to keep investors up to date through those channels as well. NewLake Capital Partners. Thank you all very much, and I hope you have a great day.